Okay, welcome back. Got my friend Simon Mikhailovich on the line with me right now. You know, you guys all know about Simon. He is a gentleman who works in Manhattan, handles bullion situations for high net worth investors. Very, very bright man. We met courtesy of Laura Stein down at the California Investment Conference, and the little blonde lady and I spent a fair amount of time getting to know Simon, and I have to tell you, I have nothing but respect for this man's intellect. He is a very, very astute economist, to say the least. Simon, you and I were talking off the air a little bit about what's going on in the economy, about how people are led to believe that perhaps everything is okay. The emperor is wearing a tuxedo as opposed to the emperor not wearing any clothes. You have a very, very interesting scenario on that, a very interesting scenario as to what is going on right now. Can you share that with our listeners?
Sure, absolutely. What we're talking about is that the United States and the Western world in general is going through a process of deleveraging. That's meaning, and that's nothing that your listeners don't know, and it's nothing you haven't discussed before. There's too much debt, and the debt cannot be repaid. Mm-hmm. Like in any bad situation, there's a way to work it out very painfully and quickly, or less painfully and over an extended period of time. So what we're talking about is the four elements that are involved in trying to get from here to there are some way to reduce debt, some way to tighten your belt, which is austerity, some way to transfer wealth from those who have it to those who don't have it,
Sure.
and some way to monetize the debt, so to reduce the real value of debt. So yes, we still owe a lot of money, but it doesn't feel as much. I'll give you an example. On 57th Street in New York, there's a Carnegie Hall. I looked it up for the purpose of thinking about this, while I was thinking about these things.
All right.
Carnegie Hall in 1890 cost $1 million to build, land and construction.
Downtown Manhattan.
It's the premier venue for classical music.
Yeah.
It's a beautiful, beautiful building. Across the street from Carnegie Hall right now is going up a tower. It's called 157 West 57th Street. Mm-hmm. It's an 80-story tower, the bottom of which will be Park Hyatt Hotel and the rest of our condominiums that are being sold. The penthouse is being marketed for $110 million. It's going to be on the 78th floor, 6 bedrooms, 10,000 square feet. $110 million for a box 80 stories high, when 120 years ago, a monument, architectural monument of incredible value, was built for $1 million. So when we're talking about gold and when we're talking about all these things, we're talking about nominal targets in prices. In our understanding is today's dollars. I was listening earlier your conversation on Kitco today, and people are talking about maybe target of 2,000 by the end of the year. In what money are we talking about?
Yeah.
I think that you cannot divorce the things I'm talking about with deleveraging and the prices that we're talking about in nominal terms from the real terms. So the point I was making with this deleveraging is that the elements of reducing the debt through monetization, through some defaults, through some tightening of the belts, and from taking from the rich and giving, or from people who have the money, which is the savers, and giving it to the people who don't have the money, which are the borrowers, is a process that we're going through. What pace it goes on under, the Fed is trying to make it slowly. They're trying to create a situation where they can preserve social cohesion, where they can preserve some semblance of normalcy and put people to sleep as their savings are being taken away, quietly and slowly. And that is the point of owning precious metals, and that is the point of owning hard assets, and that is the point of being diversified, because we don't know exactly which way it goes. The danger, the path that they're trying to walk has two sides to it, or two, whatever you want to call it, two ravines on both sides. Deflationary collapse on one side and hyperinflationary collapse on the other side. They're walking a tightrope. Can they walk it down all the way? I don't know. Europe, the exogenous factors are plenty. Chinese crash, European crash, banking crash, any one of these things can come in and derail this scenario. But the positive scenario that Bernanke is trying to implement, relatively positive scenario. In other words, you're going to lose all your money quietly. and slowly, you may not even realize it while it's happening, is walking this path of balanced stealing from those who have it and giving to those who don't, having some people default, printing some money along the way. And that's what he's trying to do. And that's why, so that's your good case scenario. You know, you wake up and you don't have anything. It wasn't overnight. It was over an extended period of time. So therefore, I think precious metals and things that preserve their value over time against debasement, not just precious metals, could be some real estate, could be art, could be collectibles, could be various types of things, maybe interest in companies and things like that as well. That is what I think people need to do in this environment.
I got an email from a listener on our blog. I want to read this because it is so appropriate to what you were saying right now. Sean says, I've always tried to live a life that is devoid of counterparty risk. I have no debt, no mortgage, one well-built older car, and I live very close to public transit. My family only has one credit card that is always paid off. I also own 4 new pair of expensive walking shoes at all times. I have investments in art, gold, and silver, bullion, and precious metal stocks, mostly juniors. I have to tell you, this is a man that who, in my opinion, really, really has his act together. Now, I guess the question, Simon, I have for you is, I don't see this whole situation as playing out well. Do you?
Well, personally, I don't. But so far, we have to say that the attempt is working. So far.
Yes.
Right? I mean, they being the powers that be, managed to stop the crisis of the 2008. I guess the best way to describe it is this. It's like a heart disease. There is disease, and then there's a heart attack.
Yeah.
A heart attack is an acute moment in the progression of the disease. And just because the patient has been stabilized and the heart attack itself has been stopped, it doesn't solve the heart disease issue.
Mm-hmm.
So the disease we got, and that's what we're living with. And, you know, you need maybe heart surgery, but we don't want to do surgery because that's very painful. That has all kinds of risks with anesthesia. I'm using a medical example, but it's obviously it's an economic body.
It's exactly right, yeah.
Right, and so the underlying condition has not been taken away, and we're living with it. So the central banks are trying to create the environment where they think that the patient being the wealth here,
mm-hmm.
that the wealth will die slowly over time, and by that time there will be something new going on.
Yeah.
But you know, that's a hope. Whether it's going to work out or not, I don't know. I mean, it's hard to predict, and it's difficult to envision that you can calibrate something this complicated in such a fine-tuned manner for an extended period of time without some sort of debacle. Nobody has ever done it before.
It strikes me as being almost an impossible task. I want you to do me a favor, describe your firm, Idesis Capital.
Sure. I mean, Idesis Capital is a firm that's, for the past 15 years, has been focused on structured credit, which has nothing to do with precious metals. But over the last 5 years, we've started personally to protect our wealth investing in precious metals. And a year ago, we concluded, on the basis of our understanding of what happened in the financial system and how the over-leverage that we're suffering from has been achieved, which is through securitization. Its ability to transfer risk without people who are buying the risk understanding what they're doing. It's abnormal lending, if you want to call it that way.
Mm-hmm.
Most of the debacles of the past, of credit cycles of the past, have been based on normal lending, which maybe was over-optimistic, but it was normal in the sense that people who were lending the money had reasonable basis for expecting the money to be paid back. When we went into securitization model of lending, we have moved into an area where people who were lending the money had, and still don't, have any basis for concluding that they will be repaid back because they're relying on the ratings of the rating agencies and they're not doing their own credit analysis. So lending money to Greece, for example, is an exercise which clearly is abnormal lending. Nobody expects to be paid back. So in that environment, we've concluded that to preserve wealth, we've gone through different types of assets and thinking about it, and concluded that assets that would protect wealth have to be outside the financial system because the financial system, we believe, has been compromised and remains compromised. It's a polite word for insolvent. And so what are those assets? So there could be, as I said before in this program, could be real estate, it could be art, it could be other things.
Mm-hmm.
The problem with a lot of assets that are not gold is that they're not ubiquitous. There's not a one price. They're very subjective in valuation. And so while they do preserve, and land and things like that, so while those assets do preserve wealth, what I would call through the trough of the crisis,
Mm-hmm.
in other words, over a very extended period of time,
yeah.
in order to get real value back, You need functioning markets. You need stability.
Right.
Nobody is buying farmland in the middle of a crisis. Nobody's buying Rembrandts or paying fair price for a Rembrandt in the middle of a crisis.
Right.
Gold, however, is a form of currency. Whether you like the price or don't like the price, it's a fair price every day because it's a price that's quoted on exchanges around the world. There are 2 fixings a day for gold. They're published. So nobody will say to you that today in Philadelphia it's $50. I'm quoting from a movie, Trading Places, where the hero is trying to sell his $6,700 gold watch in a pawn shop, and they tell him that today in Philadelphia it's $50.
I've never heard an argument any better than that for purchasing gold. Stick around. We're going to be back with the second hour.
For our upcoming appearance schedule, visit kereport.com. The Korelin Economics Report will be back in just a moment.